Up to this point, we've analyzed the income statement-based profitability ratios separately from the various asset and working capital ratios. The return on investment ratios put the two together to look at the amount of bottom-line net income that has been created given the level of investment, where investment can be measured in different ways. In this segment, we'll look at two versions of the return on investment, return on assets and return on equity. The return on assets, computed by dividing net income by total assets, is similar to the asset turnover ratio. As you may recall, asset turnover is a measure of how efficient the firm is in generating top-line sales given its investment in asset. The return on assets ratio drills this down by asking how efficient is the firm in generating bottom-line net income given its investment in assets. What makes this ratio of particular interest is the fact that it can be broken down into two ratios that we've already looked at, net margin and asset turnover. Multiplying net margin by asset turnover will give us the return on assets. In other words, ROA is created by some combination of profitability, net margin, and the volume of sales generated, asset turnover. Firms that employ different strategies will have different combinations of net margin and asset turnover. Examining the components of asset turnover can provide insight into the strategy a firm is using to generate its ROA. NEBCO has a return on assets of only 2.3%, which is driven by a profit margin of 1.5% and an asset turnover of 1.6%. While this is a little hard to interpret being the first year of operations, I think it's safe to say that the managers at NEBCO would like to improve both the profit margin and asset turnover. Let's suppose that due to the expectations set by their investors, NEBCO targets an ROA in year 2 of 15%. How can they get there? Thinking in terms of profit margin and asset turnover reveal different possible strategies. Different values for these ratios driven by different strategies will produce the same 15% ROA. A profit-driven strategy would focus on trying to contain expenses in order to increase net margin to 9 or 10%. If this were possible, then asset turnover could remain at 1.6 and NEBCO could still achieve a 15% or better ROA. Or they could pursue more of what I'll call a sales volume strategy by trying to drive sales while limiting capital investment, hoping to get asset turnover up into the 2 to 2.5 range. If this could happen, then they would only need to drive net margin up into the 6% to 7.5% range. Think about what this would mean for a boat manufacturer like NEBCO. Think about what it would mean for your company. Strategic initiatives aimed at increasing net income and the net margin ratio can be very different from initiatives aimed at driving sales volume. Each strategy comes with its own requirements around money, people, and processes. Trying to figure out which strategy is best at a particular point in time is really what keeps managers awake at night. That's what management is all about. And these relatively simple ratios, net margin, asset turnover, and ROA, can give us a great line of sight into this process. Return on equity also looks at how much net income the firm generated, but this time in relation to the investment made by owners. So instead of assets in the denominator, we have stockholders' equity. Here we see that the owners of NEBCO earned net income of $47,000 on their investment of $752,000 for an ROE of 6.2%. Compare this to the return earned on all the capital supplied by both owners and creditors, which is the return on assets of 2.3%. And like ROA, we can break ROE down into sub-ratios as well: net margin, asset turnover, and a new ratio, financial leverage. Financial leverage is used to capture the degree to which the owners are using either their own money or borrowed funds to finance the business. Financial leverage is calculated by dividing assets by stockholders' equity, 2.7 for NEBCO. Leverage is one of those terms used in finance that always seems to intimidate people because it's not obvious what is meant by the term. The simplest way to think about leverage is this: whenever you hear the term leverage, just think debt. The more leverage a firm has, the more debt it's taken on. That's it. Highly leveraged firms have more debt. To see how leverage works, compare the returns assuming no leverage with the current returns for NEBCO. With no debt, NEBCO is financing 100% of the assets with the owner's money. There is no debt, no borrowed funds. With no borrowings, interest expense would be zero, meaning earnings before tax would be $150,000. Taxes would be 35%, or $52,500, and net income would be $97,500. This would give an ROA of 4.9%, which would be the same as ROE since there are no liabilities. Compare this with the current situation at NEBCO, which has effectively replaced $1,248,000 of owner's money with debt, supplied by vendors in the form of accounts payable and accrued expenses, and supplied by banks in the form of long-term debt. Because of the interest expense, net income drops to $46,800. But while the absolute amount of net income is lower, net income as a percentage of the money the owners have invested, $752,000, is higher at 6.2%, a higher return on equity even with a lower dollar amount of net income. Thus, the wonders of leverage. By using other people's money, borrowed funds, the firm is able to leverage or increase the return to owners from 4.9% to 6.2%. With three variables driving ROE, there are many different paths a firm can take to achieve a high return for the shareholders. While this table illustrates the multiplier effect that leverage can have on profit margin and asset turnover, it does not come without a costly risk, and that is the higher interest payments that come with debt. So while Company A is able to earn an ROE of 30%, they do so in a very risky manner, with high levels of debt and much higher interest expense. This puts tremendous pressure on management to earn sufficient profits to cover that interest. The other two examples show different paths to an ROE over 30%. Company B, we would say, is very conservatively financed, meaning lower leverage, but also a very profitable firm. Companies in this situation will often be pressured by investors to actually increase leverage in order to increase the ROE. Managers must consider this decision in light of the amount of the increased interest and the predictability or dependability of future earnings required to cover that interest. This is not to say that one company or one path is better than another. Each situation must be evaluated in terms of the firm's ability to generate consistent earnings and cash flow sufficient to cover their interest payments.